Hello everyone. In this video, I'd like to use the Excel spreadsheet I created by myself to go over the cost flow and cost reports covered in Chapter 3 and Chapter 4. One for the job order costing system and the other one is the process costing. But the first worksheet you see is a general cost flow illustration. This file I posted under the announcements and also should be delivered to your email. In this illustration, we have a balance sheet account and income statement account. On the balance sheet, the cost flow for a manufacturer company will go through three inventory accounts: raw materials, working in process, and then finished goods. Once the products are completed, their cost will be transferred to the cost of good under the income statement. So that's a flow between the two type of financial statements. And manufacturer overhead is a special indirect product cost. The overhead capture all of the supporting product cost over the accounting period. We use the applied overhead rather than the actual overhead to add to the working process. So in the end of the accounting cycle, we'll have some overhead balances because the actual overhead won't equal to the applied overhead for most of the times. So either the under applied overhead or over applied overhead balance will dump or get rid of the balance by move the difference directly to the cost of goods sold as adjustment. Or if you want to be more accurate, the balance can be spread out between your working process, finished goods, and the cost of goods sold by percentage. This approach is explained in details in the ebook, so I'm just here only mention briefly. And now let's get to see the flow between the three inventory accounts. Raw material is a typical current asset. For manufacturing industries, it represent or include all of the materials. The main materials will become the integral part of the final products. A company can have thousands, hundreds, or even like 10,000 different types of materials, right? Depending on the product requirements and the design of the products. Here I'm using a general ledger, like a controlling account. And you remember in the SAP introduction, raw material is covered in the system, is the master data for different type of raw materials. For asset account, this is more accounting rules for the T-ledger account. For each asset account, we should have a beginning balance on the debit because debit means increase for asset account. Theoretically, we should have positive balance for material. So you see the beginning balance on the debit. And also we report any new purchased materials, right, over time in the accounting period on the debit side as well. You should have multiple purchases during an accounting period. So debit covers the beginning balance and also the newly purchased. Then material used for production, for indirect materials, all direct materials will be deducted as credit under the raw material account. I don't require you fully understand the journal entries like debit, material, credit accounts, payable, but if you just check briefly, that really help us understand the flow of the cost and also this mingling of the financial accounting and the managerial accounting system. So the usage of material can be direct. So direct, that's when we refer to the product as the cost object, right? That's the direct physical part of the product. The material can be also used as supporting purpose, like lubricates or like the sandpapers we had in the chapter 2 Excel homework. Sandpapers will be likely a supporting material, so indirect materials. But anyway, after deducting all of the material used from the credit, you should have an ending material balance. And this ending material will be reflected as part of your ending inventory balance. For companies in their balance sheet, because of the limitation of the space, you may not see the detailed breakdown of material working process and finished good under their inventory account. If you desire this detailed information, you should be able to find in the notes. Or in the notes following the financial statement, you will have an idea the distribution for the three type of assets. So that's raw materials. And for labor cost, direct labor, indirect labor, or even the labor cost related to a period cost. In accounting, we use accrual accounting system means when you recognize the labor expense or labor cost, they may not have been paid, right? So like in the people work first, then got paid later for most of the cases. In that case, the labor cost recognition will be matching with a liability account we call wages payable, which is a current liability. So that's the wage already incurred, captured, but not paid. Okay, we can have direct labor, the assembly workers, or indirect labor, such as the maintenance people, factory supervisors, their salary will be captured by the manufacturer overhead. And even we can also have the admin, selling, general labor expenses unpaid and recorded by the wage payable, but I didn't include that item, so I even can put period labor expenses. So wage payable handles the temporary liability we hold for all types of employees for the company. But when we put on the debit side, right? So the where the labor cost incurred, then we can differentiate either direct labor is got to be under the working process. If the indirect labor is recorded by the manufacturer overhead, and if it's a pure period expense, it goes to your sale, admin, and general expense, even not involved in the manufacture process. So direct labor, these two are always variable expense. Then overhead is special, as I mentioned earlier, because of the timing, when we try to capture the cost for the job or the process, all of the overhead data, actual data may not be ready yet, such as your utility bills and the depreciation calculations or some of the allocation of the common expenses. We haven't really been able to figure out the actual overhead when we need the overhead data to compile your cost reports. And also, if you use actual overhead, it can cause many fluctuation of the cost, especially for seasonal productions. Utility expense, right, between the summer and winter can be significantly different. So for all of these reasons, we use a approach applied overhead. So it's like a standard rate we determine in the beginning of each normally the yearly overhead rate. Based upon the budgets in the beginning of the year, we'll figure out a overhead rate. It's like a price per cost driver, right? Like per direct labor hour or per machinery hours. Then we'll apply to the production using this estimated rate with the actual consumption of the cost driver, like how many direct labor hours we actually used, or how many the machine hours we actually used. Multiply by the predetermined rate, we can figure out the applied overhead whenever you need the cost data to compare a cost report. And it also helps us to finish the cost reports timely. We offer relevant information to the users. So apply the overhead added to the working process. Then many of the, even under the job order costing or process costing, we may have something already started from the prior accounting period. So that's the beginning balance of your working process account. Mostly we call WIP or WIP working process. So you have some unfinished products in the beginning and then add the new, be careful, the new manufacture cost, the 3 additional inputs in the current period. And then we'll figure out how many unfinished products, right? Like by counting the physical count of the units. And lots of the technology will help us to figure out the unfinished or ending working process. So beginning working process, add all of the current manufacture cost minus the ending working process. That will be the cost of goods manufactured, of which a concept we introduced from chapter 1, chapter 2, and now you will see exactly where and how we can generate this number in the cost flow process. So this cost represents the cost for the finished products in this period only, not the cost inputs. It's part of your cost inputs because not all of the products we started have been finished. So cost of goods manufactured, remember or understand it. So that's the cost for the completed finished units, which are ready to be sold to customers. So this cost, so if you can visualize, as the finished units physically are moved to the next step, which is the finished goods inventory. And a company may have a finished good warehousing, right? Like, another location to hold all of the finished products. Or maybe you have a designated area in your manufacture facility for the finished products. So depending on the size of the company or the storage, conditions of the products. But this is a first important, like internal cost report. Cost of goods manufactured is only for internal managers. Right? We prepare, so not for external. So we can see cost accounting. We are sharing data or use the same data as financial accounting, but we are preparing the reports especially for managers in this case. So continue the flow under the finished goods or finished products. You normally have some beginning unsold, right? So finished in prior periods but unsold. Now adding the newly finished products, then minus the products sold to customers in the current period. Or you can do or you use the beginning plus the cost of goods manufactured, which equals to the all available goods for sale minus the ending unfinished, right? You can get the cost of goods sold. So for asset account, the general formula or the common structure is you have a beginning balance, add the new items, like new purchased materials or new added manufacture cost, or the new finished products. then minus the credit side, okay, by different meanings, then should equal to the ending balance. Or you use the beginning balance plus the newly finished minus the ending should equal to the cost of goods sold. So there are always these four numbers under the two accounts and it's balanced. Okay, it's like a formula, have four items in the equation, right? If you know any three of them, you should be able to figure out the missing one. And that's actually the third homework question in chapter 3 is trying to check. Okay, have you fully understand? Okay, rather than just working on the direct way, if I give you this formula or the equation with the three pieces of information, can you figure out the missing one? Okay, that's kind of the focus. And that's really a way to help us understand the flow and the relationships of these numbers. Not probably I can put it here as like a begin balance plus the newly, we just use a common term, okay, newly added, should equal to the ending balance plus the decreased item, because in different accounts, the decreased account represents different meanings, right? But anyway, so the beginning plus the newly added then equals to the minus, like which is the decrease, and the ending finish the good. So if you see this formula or equation, if we know any three of them, we can figure out the missing one. So after the cost of goods sold leaves the finished good, physically, right, those other units we sold and shipped or delivered to the customers. And following the physical flow, the cost of those units will flow to the income statement. Okay, that's the link. Okay. So product cost flow. Initially, everything is in the production process, and then eventually only the cost for the completed and sold units move to the cost of goods sold in the income statement, because the cost of goods sold will be matched with your sales revenue to figure out the gross margin before we minus all of the period cost. Okay, so income statement account. And then the period expenses, which is in comparison to the product cost. Selling element and general expense, they are not product cost, but they are supporting non-manufacturer expenses. So their amount, we capture all of them on the different period expenses. Here I'm using a combo account. In actual accounting system, you may have multiple expense accounts. For example, selling expenses, admin expenses, or other general expenses to capture all of the period cost. And these expenses will directly be posted or added under your income statement as a deduction after your gross profit. So sales revenue minus the cost of goods sold, that's your first product number, gross product. Then minus the period expense, we can get the net operating income. But the key point here is that you can see the period expense didn't go through the manufacturer setting at all. Okay, they are supporting expenses. But the product cost is flow, all the way from the beginning, the planning, material, as we went over through the SAP, and eventually arrive the income statement. Okay, so the numbers should be relevant to the sales revenue. So by going through this, But the final thing is the overhand balance, right? As we talk about the overhand, because on the debit, we use actual numbers. So capture all of the actual overhand. On the right, we apply the overhand by the estimated rate. There are got to be some under-applied or over-applied overhand in the end of the accounting period. And this number we dump directly to the cost of goods sold or as a simple. So there are two different options. A shortcut is if you don't have large balance under the WIP or finished goods, then we can dump the balance of the overhead directly to the cost of goods sold as an adjustment, as a adding adjustment or minus adjustment. If you under-apply, if you didn't add enough the overhead, now we add it to the cost of goods sold. On the contrary, if you over-added, during the working process, then we deduct as adjustment for the original cost of goods sold. So in this chart, rather than knowing all of the flow, that's help us understand the two major cost reports, but also even your income statement. So cost of goods sold, cost of goods manufactured, and the income statement. Under the cost of goods manufactured, you may have a mini module about the direct material used. Because this one, it should be the beginning balance plus the new purchased material, then minus the ending material. Okay, that's definitely will give us a application. Okay, because when you work on this on the table formats, okay, the table is just we transfer the balance or the numbers, convert them into the presentation in the tables, but the numbers are originally exported from your financial ledger account, or each will be having a different placement in the cost reports. So this is the general illustration for the cost flow. Then the next two worksheets, chapter 3 application to the job order costing, then chapter 4 the process costing. For chapter 3, I'm using the example you see in the book, in the ebook. So plug in the number. In the book example, we have two job orders for the paddle boats. Okay, the paddle standard like paddle boats. So job order costing because they manufacture this unique, like small volume of specialized paddle boats. The company has two job orders opening in the current period. Okay, we have two job orders. The one they started and complete is the 116. So my cost flow focus on the one we started and finished. The other one we started, you have some beginning balance and you also add more cost items, but it's still on the not done yet, or we haven't completed. So follow the general flow we have from the prior worksheet. You can see for this company, the raw material, you can match these numbers with the book illustration. Or beginning, newly purchased, and the direct material used for both of the jobs. So 18,000 is for job 116. The indirect labor in the example is not coming from the raw material, it's for some additional inventory like a consumable material, like consumable materials. So raw materials means again the material directly become part of the product body, right? Really the integral part. But you may have some like supply, use it for indirect purpose. Okay, so that you have a 200 indirect material, but not put on the raw material account. And then direct labor and indirect labors. Direct labor and indirect labors. Overhead, we have applied overhead for 116 and 42. So check the book for how they get the numbers, the calculation, the rate of the overhead, and also the actual, I believe is machinery hours as the cost driver. Oh, you see the numbers. And here I'm focusing on the cost flow and the different cost reports. So now let's focus on the 116. Okay, so new manufacture cost, right? So nothing in the beginning. So this is 0. Direct material, direct labor, and applied overhead. Everything is completed. So with 48,000 cost of goods manufactured. COGM means the cost of goods manufactured all flow or moved to the finished good, 48,000. So nothing left over, so no ending balance. So that's kind of the feature of the job order costing. The cost object is for each different job. Okay, so you track or trace the expense for each job because that's the focus of the cost management. Then under the finished goods, we have 12,000. That's for 116 model. And add the finished one, right? So like 60,000 is the total finished good available for sale. Then minus the sold one, the sold units, the cost for the sold units, and this is the cost of goods sold. Then you have ending balance for the finished good. So the ending balance stay in the balance sheet as part of your inventory account. Okay, so your total inventory will be the ending raw material, the ending work in process, we got for job 42, and then the ending finished goods balance. So those three will be added as your inventory balance. Now follows the following the cost of goods sold to the income statement. And the matching sales revenue is 54,000. Again, that's T account for revenue. Credit means increase. Always I will put on this side because that's the double entry system, right? So we design all the this different debit credit rules, the double entry system. So make sure for each journal entry we have a debit, at least one debit and at least one credit, and then the total debits to equal to the total credits. Oh, that's the beauty of the double entry system. So that's give the accountants, especially before we have all of the computer help, a quick way to check the correctness and accuracy of your journal entries. Okay, so sales revenue increased by credit. Asset and expense increased by debit. And then we have a under applied overhead. And how we can know that? Okay, because the actual overhead incurred total is smaller than the applied overhead by $250. So this $250 is like we add less, okay, to the working process. Now we move this $250 entirely as a adding adjustment to your cost of goods sold on the income statement. That's under applied. If it's over applied, that will be put on the credit side, means a minus adjustment. Okay, so after this under applied overhead, the adjusted cost of goods sold is a little bit higher than the original cost of goods sold. Then finally, collectively, I put the sales, general, and admin expense together on the income statement only with 14,800, or is on a combo account. So after we put like the make sure all of the number flow in the correct place, now you can compile the different statements or cost reports. The cost of goods manufactured, again, my focus is on the job of 116. So the number I'm adding here doesn't include the 42. If you read the book, the number in the book, they include both of them. So it's slightly different. But here I want to present clearly about the finished job. So I'm only including the finished job. But the structure is identical to the book, okay, when they combine both of the jobs. So cost of goods manufactured, okay, I put the current input, right? So that's corresponding to these three numbers in a larger account. That's your total manufacture cost with no beginning balance. And that will be the same because we have no beginning balance. The total manufacture cost to be accounted for is equal to the current cost. But if you have beginning balance, this number will change, right? For example, if I add a to what I'm trying to. So if I have a beginning balance, for example, 500, that will change. You know, this one didn't. So this one will, if I change the formula, the formula should be this. So when you receive or check the Excel I sent to you, I all really encourage you to check the formulas, all the reference of the sales I used in the system, because that really tells you how the numbers flow in the system and where the numbers will be captured by the cost reports. No. So, but now I'm turning back to zero again. Okay, so the cost of goods manufactured only for 42. And then the cost of goods sold. That's formatting. Cost of goods sold, we have the original cost of goods sold, and also adding the under applied manufacture overhead. Okay, so if you want to see this, so if I want to have a separate item for the original cost of goods sold, okay, I can do that. And then the adjusted cost of goods sold will equal to the original, and depending on the sum of your adjustment on the applied, I will add it okay, on the you know after the original. So cost of goods manufactured, then cost of goods sold. These two are internal or internal cost reports. And then we'll add this number to the income statement, which we offer to external users. So external users, they see a brief summary of the income generation, like the performance report, sales revenue, and matching the cost of goods sold, right? But there is no much details, no many details. And they couldn't really tell where this, how they know, oh, was it beginning, new, later. They only have a brief idea, or like the general idea for the entire accounting period. The detailed information is not disclosed to them, okay, for a variety of reasons. So gross margin, then minus the SG&A period expense, or if you have some other research development or other related operational expenses, you can deduct after the gross margin. Okay, then we got the net operating income before you deduct income tax expense, or add minus additional revenue or expenses, or such as your interest revenue, dividend revenue, or extraordinary gains and losses. Okay, but the main net operating income. Okay, so this is the external. You can see external statements, balance sheet, income statement, but these two are only for the internal users. So I will stop here. So hope this help us understand better, because I know the book use long, lengthy pages to present all of the detailed journal entries, ledger accounts, and then the cost reports. But I want to give you some really summarized and the really the focus, right? So what really we can get out of all of the descriptions and the accounting treatment, the essential information we pulled out of the system, and then how we can use it for different purpose.